Hello, everybody, and welcome. So today we're going to be going through and looking at more Securities and Exchange Commission forms. We're going to be going through and looking at Form S-1 as well as Form S-3. My disclaimer and copyright notice: the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to the South Orange County Community College District, as well as Irvine Valley College. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2025 by Bennett Tchaikovsky. All rights are reserved and any distribution is strictly prohibited. Note that this presentation will refer to companies and other parties, the third parties. I do not claim any copyright that belongs to those third parties. So just give me one moment. So when we go through and a company is about to go public and they're going to go through and raise money, generally what they're going to do is they're going to file a registration statement with the Securities and Exchange Commission. And if we were to kind of go through and look at, again, what is Form S-1? Again, thank you, Investopedia. You guys do an absolutely amazing job, or the company does an amazing job. At S-1 is an SEC registration statement that you want to be listed on an exchange and also sell stock for a company that's usually filed in connection with an initial public offering. Any amendments or changes is going to be basically filed as a Form S-1A, and then the issuer is responsible for any material misrepresentations or omissions. So there's a pretty heavy liability when you're filing a Form S-1 with the Securities and Exchange Commission. But again, this is something that, if you are going to be going public, this is how you're taking those shares and you're basically registering them essentially for sale, which is how it's a little bit more of a complicated process than that. But the registration statement is a very important part because this has to be reviewed by the Securities and Exchange Commission. If the Securities and Exchange Commission don't approve it, your company is going to be unable to go public. So when we go through and look at basically what is included in this, you have a variety of essentially of different items, and including you're going to have like the prospectus, for registration statement, and outside cover front page. Just kind of pointing some of these out. Use of proceeds. So obviously this is being used to raise money. And what that really has to be is that, well, how are those proceeds going to be used? How are they going to be used in the business operations? Are they paying off debt? How are these being used? And a lot of how that gets phrased is really going to be up to the investment bankers, because obviously what an investment banker may want to see, and remember, the investment banker is the one who is helping the companies going through and raising money. What they're going to want to see as well, if you have proceeds and you're paying off a bunch of old debt and not putting it into the business to expand the operations, that may not make a lot of sense. So also, how is the offering price being determined? What is the dilution? Who are the selling security holders, right? So it may be not just the company issuing more shares. There may be some other people that are selling their stock. Description of securities to be registered, interest of named expert and counsel, information with respect to the registrant, and et cetera, et cetera. So best way to kind of go through and look at this, and again, I keep on using Meta Platforms, but it's because they have some great disclosure. And let's just go ahead and look this up real quick to maybe get a little bit of more of a history. So what you can kind of go through and see is that for Meta Platforms, which was a pretty big offering, so they went through and basically filed their registration statement. And then it looks like after each one of these over here, and I'll show you one of those momentarily, they were asked to provide additional information. So this is kind of the history of what Facebook or Meta Platforms had to do in terms of when they went through and went public. But as you can see right over here, their initial registration statement is right over here. And you show, okay, this is how many we're proposing. Basically, we're going to raise 5 billion at 6 cents per share, basically a par value of the stock. And exactly, what is, what's this is just kind of like more of just like a little bit about the company, the prospectus summary. So this is what they're basically going through and using to go out and to advertise to investors. And as we look over here, this Facebook was Meta Platforms when it went public. It's a little bit unique, mainly because I believe I'm not sure if they've ever not been profitable, at least, in terms of what they've been going through and doing. And let's just kind of go through and find their numbers and just give me a moment. So right over here, so you've got basically the financial statements of Facebook, and these are going to be in the back in terms of being an exhibit. But as you can see, even as back in 2009, which was only a few years after they had actually gone public, they were actually profitable, which is somewhat unique for a lot of companies at that time. But when you go through and kind of see what the contents are, prospectus summary, the risk factors, extremely important. And by the way, when you register shares, this carries a much higher liability due to how it's being covered. But when you're doing an IPO and if you do make material misrepresentations, it's not good. So over here, it's kind of telling you, forward-looking statements, industry data, just to kind of tell the user, the potential investors about what they're doing, capitalization, the dilution that's going to happen, a letter from Mark Zuckerberg, management of the company, executive comp, related party transactions, principal and selling stockholders, and basically right over here, you kind of see the beneficial owners. They're not offering any of the shares. This is kind of showing over here, though, what they basically actually go through and own. So everything that's being sold is coming out of the coffers of the company. So let's just kind of go back and take a look again, go through this over here. Description of the capital stock, material U.S. federal tax considerations for non-withholders, underwriting. So here, where the underwriter is basically for this, it was obviously several different underwriters going through. When you have this, it's usually this large of an offering. You're not going to go to just one investment bank. It's going to more than likely be a consortium of different banks. But again, that's kind of worked out between the investment bankers, but they generally do pretty well in terms of receiving fees. So you'll see this over here. It's like the different pricing and everything else. So this is initially basically what has gone through and is filed with the SEC initially. And then what you'll see happen is you'll see basically these are different amendments to the document. Now, and you'll kind of see that more information is kind of being brought up here, or this is like they're amending certain parts of this. But what you're really going to notice here is when you look at all of these different iterations in terms of what's going through and being filed with the SEC, you see all these different, filings of it. Why are they continuing to amend it? Well, if if say for example, if their numbers like, so say for example here, this might be they have to amend it because the numbers may go stale. And what that generally refers to is that, well, this very first registration statement had the audited financial statements for the year end. But if you're waiting, so if we're now into, say, August of 2012, which is not the case, then these numbers are not necessarily really longer current. So I would have to update the SEC. I would have to go through and update the statements. So this is really like when you're doing an S-1, it's a huge document. There's a lot of information, but if you kind of think about it, we're trying to make enough disclosures so someone who is initially purchasing the stock has protection. Now, here's something over here where you have like what happens is when this is submitted to the Securities and Exchange Commission, the Securities and Exchange Commission then writes back to the issuer and says, we want you to address certain things. This is something called a Securities and Exchange Commission comment letter, meaning they're commenting on certain different parts of what you're filing. And so when you get a comment letter, you have to go through and file a response. And you want to try to file these as quickly as you possibly can, or how quickly you need to get the information. So, ladies and gentlemen, we're submitting this letter on behalf of Facebook in response to from the staff of the SEC, received by electronic mail on March 22nd. So this is being filed on March 20th, so it's within 5 days, to the company's registration statement. And by the way, why are they responding so quickly? It is because in order for Facebook or Meta Platforms to sell stock, they have to have a effective registration statement. So if the SEC doesn't like something that you've disclosed or they want more information, you need to get it back to them quickly. Because if you wait or delay, it's not a good thing. I've been through this multiple times with the companies I've worked for over the years. You want to try to reply as quickly as possible, or if you can get that information. So coming over here, so it's basically this is over here. The first staff comment is, please tell us what happened. Please tell us what contractual arrangements you are referencing in response to your prior comment 9, the parties and their relationships, and clarify the first bullet point on page 9, right? So they're going through over here. They're talking about your response in prior comment 13, that for the fourth quarter of 2011, ads shown to users using Zynga apps on Facebook contributed less than 5% of your total revenues. Please tell us whether this is in addition to the percentage of your revenue derived from payments and processing fees related to the Zynga, basically to the sale of virtual goods, right? So this again, you're going through over here, presence of price. So again, like this is all of this over here is like every SEC comment that happens, you have to go through and then reply to it. And not only are you replying to it, you're going to file an amendment to the S-1 to show that you've gone through and have addressed those particular changes. So this is kind of like a back and forth happening between the attorneys for the company, the staff of the SEC, the auditors are going to be heavily involved. Because remember, every single time this gets refiled, because you're including audited financial statements, the auditors have to go through and see it. So you've got a lot of people kind of going through and being involved when these comment letters kind of go through. So again, this is you'll see all these different like comments coming back. And obviously, depending on the type of business it is, if it's a relatively new business, which I think Facebook was at the time, they may have really kind of said, well, hey, what's going on with this? So that's really what it might have been happening. So this is the kind of the process. Now, once you go through and once it's basically notice of effectiveness. Okay, so what happens here is once basically what's the SEC has done, they'll declare the S-1 effective, and this was May 17th, 2012. And then we say, when did Facebook complete its initial public offering? On May 18th. So literally this went effective on May 17th. They closed it right over here. Stock was priced at 38 per share and closed at $38 on its first day of trading. So this is something where, again, it went effective, and then shortly thereafter, they went through and started selling their stock. So this is an example of basically when a company goes public. By the way, I am really simplifying this. It's really complicated. This is only from the S-1 side. You have the whole other side of the investment banking. Um, I'm not going to share those thoughts here, but if you ever want to get my thoughts on that, I've got plenty to share, but it's not something I would do on YouTube. So coming back over here, Form S-3, this is the other type of, so the S-1 is when we're originally going to be going through and going public. If I want to go through and again, this is all about when a company goes public, and this is something you have to be really mindful of. How does stock actually get listed onto a stock exchange? Well, you have to have a registration statement covering the shares, which is when the company initially goes public, which is going to be Form S-1. If we have shares that we're issuing to employees under an employee stock plan, that could be done via a Form S-8, which are shares under employee benefit plans. And then those could be sold by the employees. But then there's also something being able to sell if you have stock that has not yet been registered. You can use something called a Rule 144, meaning that you're not an insider and the company you've held it longer than 6 months. And again, don't quote me on this, but you can sell it by basically filing a form under Rule 144 to go through and to sell your shares. So if it's not on a registration statement, you got to do it this way. But when you do file on a Rule 144, it's going to be open and available for everybody to see on the public. Now, coming over here is that, well, what happens when, say, a company is, so if a company, they're going through an operating, do we need to file a Form S-1 all over again? And the answer is no. One of the benefits of being publicly traded is that you can basically use a form, what we call a shelf registration or a Form S-3, which gives the ability to create shares and then the company just sells it at different increments or points in time. So this is usually going to be after a secondary offering or after an IPO has already occurred. And it's much easier for the company to go through and to do this. Now, Facebook went through and they basically filed a shelf registration for this number of shares. I do not think they sold any of these, but they could have. But I don't, it's again, if they wanted to do so, if they wanted to raise money, this could be a way they could do it. Now, would that be ideal to kind of go through and do? Answer is probably not, just because borrowing money, at least at this point in time, was a lot cheaper. But remember, when you do sell shares, you do, in fact, dilute. So that's always one of those kind of downsides. But the Form S-3 itself is not nearly as long as if we just kind of look at these kind of parts like right over here, as opposed to the S-1, which you're looking at, significantly, like if we look at just compare the table of contents between this and this, it's a pretty big difference between the two. So this is something you want to kind of, again, what does this S3 do? It's just if you're on the NASDAQ or if you're a seasoned issuer, you can go through and use this form just to sell shares. And it's a lot easier than doing it on the Form S-1 in terms of going through all those SEC's reviews. Now, could the SEC be reviewing this? The answer is sure, but the likelihood of that is not going to be that great. So in any event, I want to thank you for watching. Please remember to like and subscribe, and I look forward to seeing you on the next video. Have a great day.